Everybody is looking at the missiles, the maps, the tankers, the oil price, and the headline that sounds the most dramatic: petrodollar collapse. But almost nobody is looking at the real trap. Because the most dangerous financial shock from Iran's Hormuz crisis may not be that the dollar dies. It may be that ordinary people, investors, and even smart savers misunderstand what is actually breaking, what is not breaking, and where the damage really lands first. And that misunderstanding is expensive. It makes people panic in the wrong places, ignore the real risks, chase the wrong hedges, and miss the deeper shift happening underneath their money while they are distracted by the loudest word in the room. Here is the uncomfortable part. A lot of people hear petrodollar and imagine a single switch. One day oil is priced in dollars, the next day it is not, and suddenly the entire American financial system implodes overnight. That story is dramatic, clean, cinematic, and almost perfectly designed for clicks. It is also far too simple to help anyone protect their money. Because what is being exposed right now through the Strait of Hormuz shock is not just a question about what currency oil is sold in. It is a question about how modern financial power actually works, how fragile global trade routes really are, how inflation can come back through the side door, and why a household can get financially squeezed even if the dollar remains dominant. And that is exactly why this video matters. Because if you misunderstand the petrodollar story, you may prepare for a fantasy and ignore the real threat. You may think the danger is some dramatic reserve currency death spiral, when the actual pain arrives through fuel, inflation, rates, supply chains, credit conditions, and shrinking household margin. You may believe the dollar is about to vanish from the center of the system, when in reality the Hormuz shock may temporarily strengthen parts of dollar demand, while simultaneously exposing how vulnerable the global economy is to one narrow energy artery. So the real question is not, is the petrodollar collapsing right now? The real question is, what financial trap is being exposed by the fact that one choke point, one war shock, and one market panic can ripple through oil, inflation, the dollar, central bank expectations, and household budgets all at the same time? Because that is the thing nobody sees coming clearly enough. People assume the system is either stable or broken, either intact or collapsing. But that is not how financial systems usually hurt people. They hurt people through tension, through repricing, through pressure, through contradictions that can all be true at once. For example, the dollar can remain the world's dominant reserve currency and still leave households worse off. The oil market can become more fragmented without producing an overnight end to dollar dominance. The U.S. can keep enormous financial advantages even while Americans pay more for fuel, groceries, travel, and debt. And a geopolitical shock can expose weakness in the petrodollar narrative without proving that the dollar-centered system is finished. Those are the kinds of truths that are harder to package, but much more useful if your goal is to understand money instead of just react to it. Let's slow this down and go to the root of the problem. The phrase petrodollar became powerful because it gave people a clean story. Oil exporters price oil in dollars. Countries need dollars to buy oil. Demand for dollars rises. U.S. financial influence stays strong. There is truth inside that story, but the real system is much bigger than that. The dollar's role is not built on oil alone. It is built on trade invoicing, global finance, deep treasury markets, dollar funding markets, reserve management, payment networks, derivatives, banking infrastructure, legal institutions, and the habit of the world itself. And that matters because if you think the entire system depends on one oil pricing agreement, then any challenge to that agreement looks like instant collapse. But if you understand that dollar dominance is layered, sticky, networked, and reinforced by market depth and crisis behavior, then you start seeing the Hormuz shock differently. You stop asking, is this the day the dollar dies? And start asking, why does every major conflict still seem to run through oil, inflation, safety trades, central bank expectations, and global dollar demand in some form? That is a much more important question because it points you toward the real mechanics instead of the slogan. The first mechanic is energy choke point power. When a Strait of Hormuz gets threatened, the world does not simply worry about one country's exports. It worries about a bottleneck that handles a huge share of oil and LNG flows. Even short-lived disruptions can have outsized impact on prices, planning, and sentiment. That means your financial reality can change before any grand currency regime changes at all. Oil jumps, shipping risk rises, insurance costs rise, traders reprice inflation expectations, central banks become more cautious, consumers feel squeezed, businesses pass through costs. Suddenly, the average household is living through the consequences of a global system shock, while commentators are still arguing on social media about whether the petrodollar is over. This is the trap. People get hypnotized by the symbolic story and miss the operational one. And before we go deeper, write this in the comments. The one money habit, financial promise, or financial blind spot you want to improve after this video. Maybe it is, I will rebuild my emergency fund. Maybe it is, I will stop confusing income with security. Maybe it is, I will learn how inflation really hits my budget. Maybe it is, I will stop panic reacting to headlines. Put into words. Writing it down matters because vague intentions disappear fast, but a named commitment becomes something concrete. It becomes easier to remember, easier to measure, and much harder to ignore when the next shock hits. Now let's get into the main problem. The problem is not just that the world might be slowly diversifying away from the dollar at the margins. The problem is that many people have built their financial worldview on a false either-or. Either the dollar system remains untouchable or it collapses suddenly. Either oil keeps everything locked into place, or once that changes, the floor falls out immediately. That framing makes people stupid at exactly the wrong time, because real systems decay, adapt, and stress in messy ways. Hormuz is showing you that messiness in real time. The same crisis that has people screaming about the death of the petrodollar can also reinforce classic dollar strength dynamics. That is not a contradiction once you understand the system. It is the system. Here is why. In times of stress, people do not only care about ideology. They care about liquidity. They care about what can settle trades, absorb fear, collateralize risk, and sit at the center of the deepest markets. That does not mean the dollar is invincible forever. It means financial habits built over decades do not disappear because one headline says they should. So when a shock hits energy, the dollar can benefit as a safety asset even while the same shock raises questions about long-run fragmentation in the system. Again, both things can be true, but this is exactly where the hidden danger starts. Because households, investors, and even business owners may see dollar strength and assume everything is fine. They may hear safe haven and think the real threat has passed. They may look at currency headlines instead of their own cash flow and miss the way the damage is moving underneath them. Stronger dollar headlines do not mean your grocery bill gets easier. They do not mean oil stops feeding inflation. They do not mean the Fed suddenly has freedom to ease. The trap is mistaking market symbolism for personal financial safety. That is why the first true victim of a Hormuz shock is often not the currency regime. It is household margin. Household margin is the space between what life costs and what your income can comfortably absorb. That space is where resilience lives. And that space gets attacked from multiple angles during an energy shock. Fuel goes up. Food transport becomes more expensive. Shipping risk rises. Travel gets pricier. Rate cut hopes get delayed. Credit remains expensive. Suddenly, the family that looked stable on paper realizes stability was being held together by a thinner margin than they thought. This is one of the deepest lessons in personal finance. Macro shocks do not create every weakness. They expose the weakness that was already there. A war does not invent fragile budgeting. It punishes it. A supply shock does not create lifestyle inflation. It exposes it. A rate shock does not invent dependence on easy money. It reveals it. That is why two households can live through the same global event and experience completely different realities. One sees inconvenience. The other sees panic. Same world. Same war. Same oil. Different margin. Now here's where we need to deal honestly with the petrodollar idea itself, because there is a real insight buried inside the exaggeration. The useful part of the petrodollar conversation is that it reminds people global money power is tied to real-world flows, strategic alliances, trust, and habits of settlement. The less useful part is when it becomes a magical story where one pricing shift equals instant financial apocalypse. The world is already experimenting with more bilateral trade in non-dollar currencies, more local currency settlements, and more hedging against sanctions risk. None of that should be ignored, but it also should not be mistaken for a clean replacement of the dollar system. So if the dollar is not collapsing overnight, then what is the real trap nobody sees coming? Here it is. The trap is that people assume the biggest financial danger is the dramatic one, when a more immediate and more likely danger is a prolonged period where the dollar system remains dominant enough to keep transmitting global shocks efficiently, while households remain too financially fragile to absorb those shocks. In plain English, the system does not need to collapse to hurt you badly. It only needs to remain stressed, expensive, and inflation sensitive. That is a much uglier truth because it is less theatrical. There is no single movie ending moment. There is just pressure. Pressure at the pump. Pressure in food logistics. Pressure in corporate margins. Pressure on rate expectations. Pressure in household budgets. Pressure on credit card balances. Pressure on confidence. And if you are waiting for a dramatic collapse event to take money risk seriously, you may be too late for the version of danger that actually matters most in daily life. Think about how financial pain really enters a normal household. It does not usually arrive as the reserve currency system has changed. It arrives as the quiet accumulation of more expensive routines. The weekly fill-up costs more. The grocery receipt feels heavier. The airline ticket is absurd. The delivery fee rises. The business you work for starts talking more carefully about costs. The mortgage rate does not come down as fast as people hoped. The credit card balance starts becoming harder to shake. That is how a geopolitical energy shock becomes a personal finance crisis. And here is where the psychology gets interesting. When people feel this kind of squeeze, they often choose the wrong story because the right story is uncomfortable. The wrong story is external and dramatic. The dollar is dead. The system is rigged. Nothing matters by whatever seems anti-systemic and hope for the best. The right story is more personal and more powerful. My budget is more exposed to global energy shocks than I admitted. My liquidity matters more than I treated it. My fixed costs are too high. My debt is too expensive, and I need a more resilient financial structure whether the petrodollar survives or not. That is not as exciting, but it is much more useful. Because one story makes you a spectator, the other makes you adaptable. And this is the perfect moment to say something important. If you value this kind of finance content, subscribe to the channel. Not because it is a routine line people throw in, but because these kinds of conversations only keep reaching more people when viewers who care about practical money thinking decide to stay connected. And the more this kind of content grows, the more likely it is that someone avoids a panic trade, fixes a broken budget, or understands a major macro event before it turns into expensive confusion. Now let's go deeper into the Hormuz side, because this is where the financial trap becomes impossible to ignore. The Strait of Hormuz is not just one more shipping lane. It is one of the most critical energy choke points in the world. That means even if a disruption is temporary, the threat of disruption alone can create price spikes and supply anxiety that ripple across the world economy. Now connect that with the fact that even aggressive policy responses may not quickly bring oil back down, while traders push back expectations for Fed cuts because inflation was already sticky before the energy shock. That is a huge clue. It means the system was already vulnerable. Hormuz did not create every problem. It arrived on top of an economy already sensitive to inflation. So instead of a clean crisis, you get layered pressure. Energy shock on top of sticky inflation. Geopolitical uncertainty on top of fragile rate expectations. That combination is financially dangerous because it closes off easy relief. This is why the phrase petrodollar collapse can be so misleading. It makes people look for the one event that changes everything, instead of recognizing that the real threat is often a chain reaction that keeps enough of the old system intact to transmit pain, while introducing enough instability to make life more expensive. In other words, you do not need the dollar system to disappear for the financial trap to snap shut. You only need a major energy choke point shock to collide with high debt, thin household buffers, sticky prices, and an economy addicted to lower rates. And once you see it that way, a lot of myths start falling apart. Myth number one: if the dollar remains strong, you are safe. Not necessarily. A strong dollar can coexist with high oil, high living costs, and tight financial conditions. Myth number two: if oil is increasingly traded in non-dollar arrangements at the margin, then the dollar must be finished. Not necessarily. Incremental diversification is not the same as systemic replacement. Myth number three: the only people who need to care about Hormuz are energy traders. Absolutely not. Anyone whose budget depends on transportation, utilities, food logistics, credit conditions, and employment stability should care. Now think about what happens next in a normal household after a shock like this. Some people become more disciplined. They look at spending, cut waste, protect liquidity, and stop pretending every habit is non-negotiable. Others do the opposite. They avoid the numbers. They keep every convenience cost. They emotionally spend because stress makes them crave relief. They finance the gap on credit because changing the lifestyle feels like losing status. And that is how global shocks become personal debt traps. Not through one giant error, but through repeated small denials. This is why emergency funds become so important in moments like this. During calm periods, people love to act like cash is lazy. They want every dollar deployed, optimized, leveraged, or turned into an upgrade. Then the world gets noisy and suddenly cash becomes freedom. It becomes time. It becomes the difference between responding calmly and borrowing expensively. It becomes the thing that keeps a temporary macro shock from becoming a long personal financial scar. And let's be honest, a lot of people hate hearing that because it feels boring. Boring does not trend. Keep cash, cut fixed costs, and protect your margin is not as exciting as the petrodollar is ending. Here are the 5 assets that will explode. But boring is often what survives, especially when the world is unstable. There is another layer here that most people miss completely. The dollar's centrality is not only about benefiting America in the abstract. It is also about how global stress transmits into domestic conditions. When energy shocks hit, policymakers do not get to live in theory. They face inflation pressure, growth pressure, political pressure, and financial market pressure at once. That matters immensely for households because the path of borrowing costs can change simply because a choke point thousands of miles away gets disrupted. So the trap is even more brutal than it looks. People think they're debating a reserve currency topic, but what they are really living through is a household cash flow topic, a rate sensitivity topic, a debt management topic, a liquidity topic, a fixed cost topic, a resilience topic. They are arguing about whether the dollar will lose symbolic power while the actual threat is that their personal balance sheet cannot handle a world where oil shocks keep inflation sticky and policy stays tighter than expected. And this is where the deeper revelation begins. The true financial trap exposed by Hormuz is dependence. Dependence on cheap energy. Dependence on smooth shipping lanes. Dependence on low inflation. Dependence on frequent rate relief. Dependence on global stability. Dependence on the assumption that major systems will keep working invisibly in the background. The average person does not think of their life as dependent in these ways. They just think of it as normal. But normal is often just dependence you have not been forced to notice yet. That realization changes how you think about money. You stop asking only, what will happen to the dollar? And start asking, how many invisible global assumptions is my budget built on? Because that is the more dangerous question. Your fuel cost is built on them. Your grocery bill is built on them. Your employer's cost structure is built on them. Your travel costs are built on them. Your investment returns are built on them. Your refinancing plans are built on them. Even your sense of what constitutes a manageable lifestyle is built on them. Once that clicks, the petrodollar headline starts looking almost like bait. Not because the topic is fake, but because it pulls attention toward the grand symbolic battle while the everyday mechanics do the real damage. It is like staring at the crown while the floor is moving underneath you. Now let's talk about markets, because this is another place where people get trapped by oversimplified narratives. In a stress event, some assets can rise for reasons that do not fit the popular story. Oil rises because supply risk rises. The dollar can rise because safety demand rises. Some equities fall because higher energy costs hurt margins and tighter rate expectations hurt valuations. Gold may move. Bonds may move. Different regions may react differently depending on their energy dependence. That is a perfect example of why system stress does not produce one clean anti-dollar trade. This matters for investors because panic loves neat narratives. If you believe one headline explains everything, you're more likely to chase the wrong asset for the wrong reason. You may decide the only rational move is to bet aggressively against the dollar when the near-term market dynamic is actually dollar supportive. Or you may assume dollar strength means the inflation problem is contained when energy shock says otherwise. Or you may think owning one crisis asset solve your exposure when your real vulnerability is still sitting in your monthly cash flow and debt load. That is why mature financial thinking starts with your foundation, not your headline reaction. How exposed are your fixed costs? How much emergency liquidity do you have? How rate sensitive is your balance sheet? How dependent are you on steady employment in a margin-sensitive sector? How much of your spending is genuinely necessary versus habit? How strong is your ability to absorb a few months of higher living costs without resorting to debt? These are not glamorous questions, but they're the questions that decide whether a macro shock feels like discomfort or disaster. Now, let's get to the climax, because this is the truth most people do not see until the shock is already hurting them. The real trap is not that the petrodollar collapses and everyone suddenly has to relearn finance from zero. The real trap is that the old system stays dominant enough to keep your life tied to it, while becoming unstable enough to keep punishing fragility. That is the nightmare version for ordinary people, not total reset. Persistent strain. Persistent strain is harder to notice, harder to dramatize, and often harder to resist. It feels like a long season of why is everything still expensive? It feels like rate relief that keeps getting delayed. It feels like your income is technically okay, but somehow life feels tighter. It feels like you're working within a system that still functions, but functions in a way that keeps transferring volatility downward into households. And that is exactly the kind of trap people miss because they are waiting for fireworks. In that world, being right about some long-run dollar debate does not help much if your personal finances are built on assumptions that only work in calm environments. You can be intellectually correct about de-dollarization trends and still get crushed by a car payment, grocery inflation, and revolving credit. You can understand geopolitics brilliantly and still have no emergency fund. You can predict fragmentation in energy markets and still be living one paycheck away from anxiety. That is why the real shift has to happen inside your financial behavior, not just your worldview. The strongest financial move in a world like this is not theatrical. It is structural. Lower the fragility of your lifestyle. Raise the resilience of your cash position. Respect the possibility of recurring inflation shocks. Be careful with debt that assumes policy will rescue you quickly. Avoid turning macro fear into impulsive speculation. Build a budget that can absorb uglier reality than the one you hope for. That is how you step out of the trap. And there is something powerful about that, because it means you do not need to control the Strait of Hormuz to protect yourself from the Hormuz shock. You do not need to predict the exact future of the reserve currency system to make better money decisions. You do not need to know whether the petrodollar eventually fades in 10 years or 20 years to understand that your monthly margin, liquidity, and behavior matter right now. So what should the viewer take away from all this? First, stop thinking in binaries. The dollar can stay dominant and still deliver pain. Energy trade can fragment at the edges without producing instant reserve currency collapse. Second, understand that choke points matter. Hormuz is a financial story because it is an energy artery, not just a geopolitical symbol. Third, Recognize that safety flows and inflation shocks can happen together, which is why the same event can strengthen the dollar while worsening your budget. Fourth, admit that your personal financial system may be more exposed to global assumptions than you thought. And fifth, build resilience before you need it, because once the shock is obvious to everyone, the cheap adjustments are usually gone. If this video changed the way you see the Hormuz story, subscribe, keep learning with the channel, and send this to someone who is obsessing over petrodollar collapse without looking at the real financial danger sitting underneath it. There's also a natural next step from here, because once you understand this trap, the next thing you need to learn is how to build a personal money system that survives inflation spikes, delayed rate cuts, and geopolitical volatility without forcing you into bad debt or panic investing. That is the kind of financial growth that actually matters when the world gets noisy.